Welcome to The Way of Wealth. I'm Corey.
And I'm Lily.
Lily, have you noticed lately that the economic conditions reported in the news media feel like a completely different world from what your friends are actually experiencing?
Absolutely. On one side, the stock market hits new highs, and corporate earnings are stellar. On the other side, friends complain about soaring prices and life getting harder. This contradiction really confuses me.
Your confusion is actually the confusion of all Americans. On the 22nd of May, 2026, the University of Michigan released its Consumer Confidence Index at 44.8, the lowest reading since they started tracking in 1952. Lower than the 2008 financial crisis, lower than the 2020 pandemic, even lower than the 1970s oil crisis.
Lowest on record? That sounds really serious. How pessimistic are people?
Even more critical, 57% of respondents, without being asked, spontaneously mentioned that high prices are eroding their personal finances. This is unprompted complaining, meaning the pain has seeped into their bones, and they expect inflation to remain around 4% annually for the next 10 years. This kind of pessimistic expectation is extremely rare.
4%? That's double the Fed's 2% target.
Right. And do you know what gas prices are now? The national average is $4.55 per gallon, over 50% higher than before the Iran war. California is even more extreme, averaging over $6. For working-class people who need to drive to work, gas alone eats up a huge chunk of their paycheck.
But at the same time, aren't corporate profits performing really well?
Yes, and that's the biggest contradiction. In the first quarter of 2026, 84% of S&P 500 companies beat earnings expectations, the best quarter since 2021. Not just slightly beating expectations, but exceeding them by over 20% on average. Tech stock earnings growth is approaching 85%. Energy stocks surged 61% due to the Iran war. The stock market keeps hitting new highs. The Nasdaq broke all-time records.
Doesn't that prove the economy is healthy? If companies are making money, doesn't that mean the economy is good?
What you're seeing are two completely different economic systems. One is the economy of the wealthy who own assets. The other is the economy of the working class living paycheck to paycheck. This is what's called a K-shaped economy. The letter K, the top line shoots up, the bottom line drops down. These two lines diverge further and further, representing growing wealth inequality.
Why does this split form? What mechanism causes it?
There's a complete theory behind this, called Austrian Business Cycle Theory. This theory was proposed over 100 years ago by Austrian economist Ludwig von Mises. He pointed out that when central banks print massive amounts of money, this money doesn't get distributed evenly to everyone, and it doesn't flow equally throughout society.
Where does the money go?
It flows first to the banking system, then to large corporations, governments, and people who own substantial assets. This is called the Cantillon Effect. Money comes out of the central bank, and the people in the first circle, second circle, third circle get it first. By the time it reaches the 10th circle, the 20th circle, where ordinary people are, prices have already gone up.
So the closer you are to the money printer, the more advantage you have?
Exactly. And central bank money printing lowers interest rates. When rates drop, those close to the money printer can borrow at very cheap costs, then leverage up and buy assets. Look at those tech giants. Their corporate bond rates are almost as low as government bond rates. Small and medium businesses pay borrowing costs several times higher.
So they use cheap money to buy stocks, real estate, gold and silver?
Exactly. And lower interest rates themselves push up asset prices. Think about it. When rates fall from 5% to 1%, the same stocks, the same real estate, the present value of future cash flows discounted back increases dramatically. This is why the rich get richer. They not only get cheap money, but the assets themselves are appreciating.
What about ordinary working class people? What did they get?
The working class doesn't have large assets to leverage. They can only watch prices rise. Because the money the central bank prints eventually flows into the real economy, pushing up food, gas, and rent prices. Look at prices now. Eggs are $6 a dozen, double what they were pre-pandemic. Milk went from $3.50 to $5.50. Bread from $2 to $3.50. Even basic fruits and vegetables are up over 50%. Rent is even worse in many cities. Rent has doubled in the past 3 years. But their wage growth can't keep pace with rising prices.
So the rich get cheap money to buy assets and make money, while the poor just bear the pain of rising prices.
Right. This is the mechanism Mises saw through over 100 years ago. Central bank money printing on the surface is meant to stimulate the economy, but in reality, it creates a K-shaped society. Asset owners sit in first class, the working class gets squeezed in economy, and the pilot, the Federal Reserve, keeps printing money to make first class more luxurious while economy gets more cramped.
This reminds me of what you said before about financial addiction. Has the central bank reached the point where it can't stop?
Yes, this is the essence of financial addiction. The government needs to borrow money to maintain massive spending. U.S. national debt is now approaching $40 trillion, with annual interest payments alone nearing $1 trillion. Corporations need cheap capital to expand, especially tech giants whose business models are built on low interest rates. The wealthy need low gestures to maintain their leverage game. The entire system can't function without the central bank's money printer.
What if the central bank stops printing money or raises rates?
Then the entire financial system would collapse. Look at 2022. When the Fed raised rates slightly to 5%, banks started failing. Silicon Valley Bank, First Republic Bank, one after another went down. So, they don't dare truly stop. This is the terrifying thing about addiction. Once you're hooked, you can only consume more and more.
But how expensive are stock valuations right now? Are there objective indicators?
I'll give you 2 metrics. First is the Buffett indicator, stock market total capitalization divided by GDP. Right now, this ratio is between 219 and 232%, 2 standard deviations above the historical trend line. Buffett himself said this is the best single measure of stock market valuation.
What does 2 standard deviations mean? Can you explain more specifically?
In statistics, exceeding 2 standard deviations means an extreme value. If we look at a normal distribution, the probability of exceeding 2 standard deviations is only about 2.5%. In other words, historically there have been very few times when the stock market has been this expensive, and every time this extreme value appears, it's been followed by major corrections.
What about the second metric?
The second is the Shiller P/E ratio, also called the CAPE ratio. This indicator uses average earnings over the past 10 years to smooth out short-term fluctuations. Right now, the Shiller P/E is about 41 to 42, the second highest reading since 1871. Note, second highest in 155 years.
Second highest? When was the first highest?
During the 2000 dot-com bubble. Do you remember what happened after that bubble burst? The S&P 500 fell nearly 50%. Investors experienced a lost decade. Many people's retirement savings vanished. Many families went bankrupt.
So current valuation levels are comparable to the dot-com bubble era.
Yes, and the risk this time might be even greater. Because it's not just a tech stock bubble, it's systemic overvaluation of the entire stock market. Energy, industrials, financials, every sector is participating in this feast. Unlike 2000, when only tech stocks were in a bubble, and other sectors had reasonable valuations. This time, it's a comprehensive bubble.
Comprehensive bubble? That sounds more dangerous.
Right. When everyone's partying wildly, that's often the most dangerous moment. And now, there's a new variable. New Fed Chairman Kevin Warsh just took office on May 15th. In his past statements, he's consistently called for regime change to transform how the Fed operates.
What will he do?
That's still uncertain. On one hand, President Trump wants him to cut rates and stimulate the economy. On the other hand, inflation pressure from the Iran war remains strong. Gas prices stay elevated. If he really takes a hawkish stance, markets could face violent adjustments. But if he compromises with Trump and continues loose policy, inflation could spiral out of control.
So no matter what he does, it's difficult?
Right. This is the dilemma of financial addiction. You can't quit cold turkey because the whole system collapses. But if you keep using, your body will eventually break down. This is why we need to deploy ahead, to allocate physical gold and silver.
What should investors do now? What specifically should they do?
First, recognize one thing. Allocating physical gold and silver isn't about short-term profits. It's about ensuring that during future environmental turmoil, your family's wealth and monetary purchasing power won't be diluted by fiat currency.
You mean treating gold and silver as wealth insurance?
Exactly. Right now, gold is about $4,744 per ounce. Silver, about $76 per ounce. Are these prices high or low? Historically, they're not cheap anymore. But the question isn't about price levels you need to ask yourself. When the stock market corrects 50%, when fiat currency purchasing power devalues by half again, what can protect your wealth?
Physical gold and silver.
Right. Because if you can't touch it, you don't truly own it. Stocks can be delisted, companies can go bankrupt, banks can fail, even governments can default. But the physical gold and silver in your hands is always yours. This is why Chinese and Indian people have been accumulating physical gold and silver for thousands of years.
How do they view gold and silver?
They deeply understand that only assets you can hold in your hands are true wealth. The Chinese government even encourages people to open gold accounts and put savings into gold. Indian people give gold at weddings, give gold at festivals. Gold is part of their culture. These 3 billion people have proven one thing through thousands of years of history. Real money is gold and silver.
But many people say gold and silver don't earn interest or pay dividends. Isn't holding them wasteful?
This is the result of being brainwashed by the fiat currency system. You need to understand that gold and silver themselves are money currency created by God. Haggai 2:8 says, "The silver is mine and the gold is mine." When paper money constantly devalues, gold and silver are actually the only real money that appreciates. If you hold dollars, they devalue 4% annually. What's left of your purchasing power after 10 years? But gold and silver, their purchasing power is stable, even rising.
So it's trading time for security?
Exactly. And remember, mining stocks can also participate in gold and silver gains, but they're still within the financial system. When a financial tsunami comes, stock markets halt trading, bank accounts freeze, capital controls mining stocks can't escape either. Only physical gold and silver, in your hands, in your home, aren't controlled by any system.
What about allocation percentages? How much should we allocate?
That depends on individual circumstances. But the basic principle is that physical gold and silver should occupy a core position. If you allocate mining stocks, don't exceed 1/10 of total assets. The main position is always physical. And remember, this is the first layer of your wealth emergency kit, physical gold and silver. The second layer is defensive cash for short-term needs. Gold is more suitable for large savings. Silver has smaller unit value, so it's suitable as backup for daily transactions. You can hold both together.
Wealth emergency kit? Can you explain more specifically?
Right. Just like you keep a medical first aid kit at home, wealth also needs an emergency kit. When the financial system has problems, you can't rely on banks, can't rely on stock accounts. You need physical assets you can control. Gold and silver are the best wealth emergency kit. First layer is physical gold and silver for wealth preservation. Second layer is defensive cash to cover 3 to 6 months of basic expenses. That way, when crisis comes, you have time to respond calmly.
Corey, how long do you think this K-shaped economy contradiction will continue?
That depends on when the central bank's money printer stops. But historically, every money printing spree eventually comes at the cost of a larger correction. Consumer confidence at historic lows, corporate profits at historic highs. This kind of extreme split is inherently unsustainable.
So now is the time to deploy ahead?
Right. Don't wait until crisis erupts to start acting. When the stock market crashes, when there's a bank run. If you want to buy physical gold and silver, you might not be able to, or you'll pay premiums far higher than now. During the 2008 financial crisis, many people wanted to buy physical gold, and dealers told them straight out of stock. Wait several months, and premiums then were 3 to 5 times normal.
So being able to buy now is itself an advantage?
Right. When markets are still operating normally, you can choose calmly, allocate calmly. When crisis comes, everything changes. We plan, God provides.
You're right, Corey. Rather than passively waiting for crisis, better to actively prepare.
Exactly. What we can do is see clearly the essence of wealth and make allocations suited to this era. K-shaped economics isn't an accident, it's the inevitable result of central bank money printing. The rich use cheap money to buy assets. The poor use devaluing money to buy life. The only way out is to become an asset owner yourself. And the most secure assets are physical gold and silver. See you next time.
See you.